I'm holding last month's shipping statements. Sales are down, profits are down, the music industry sucks.
Welcome to the U.S. Family Office Realestate.com podcast with your host, DJ Van Kuren. He's from the Arsenal Family Office. Each podcast is about real estate-related topics specifically for family offices. Now your host, DJ Van Kuren.
Well, good afternoon. This is DJ Van Kuren with the Arsenal Family Office and U.S. Family Office Realestate.com. Today we're going to talk about some tax strategies for family offices in regards to the real estate, and we have the pleasure of having the president and CEO of Engineered Tax Services and the patriarch of the Gonzalez Family Office. So our guest today is Julio Gonzalez. Julio, thanks so much for being on the call today.
Oh, my pleasure. Thanks for having me.
Fantastic. So as I mentioned, we're going to talk a little bit about, tax benefits for family offices and their real estate. But first of all, I want to know is how did you get started in this business and with your company? And then tell me a little bit about your company as well.
Oh, sure. Well, my company is the largest boutique engineering tax practice in the country. So we provide federal tax studies where an engineering is required here in the United States. So there's a few niche services where we get involved with the tax code and serve as a resource to the CPA and family office community. And those are in the areas of real estate and in the areas of manufacturing, whether that be a product, software, or a widget, drugs, things of that nature. So, in more detail, what does that mean? Basically, what it means is that we provide engineering tax services in the real estate industry where, as most people are aware, real estate is the only investment in the United States that gets to be expensed. And so it inherently has a nice return because if I buy real estate investment for $10 million, I get to expense $10 million. However, in the United States, that process takes anywhere from 27 and a half years up to 40 years to expense that investment. So what do we do as an engineering firm to help preserve wealth in that area? What we do is we basically take the building and we break it down into components. And we break it down into lighting and mechanical systems and plumbing systems and landscape and flooring and coverings and windows and walls and things of that nature. And what we try to do within that report is come up for a component cost for all the assets within the building and break apart what's structural versus non-structural so that our clients can accelerate writing off their investment in real estate. And to the extent that we can identify non-structural assets that qualify for short-term depreciation, our averages from writing off a building up front over the first few years can range from 20% up to 50% in terms of, taking that building and writing it off more quickly. And why that's important is for a few reasons. One, we get to take advantage of all those tax deductions much quicker for wealth preservation. And we also, since we've identified those assets, if they're ever removed because of a remodeling phase, we now know the value of that asset and we can write that off. Because a lot of times when people own real estate, they don't know the value of the wall or the floors that they remove when they remodel, and so those assets continue to be written off and expensed over a 40-year period, although they're no longer within the building. So we help identify those so that every year our clients can write those off to help with, mitigating taxes and obviously preserving cash. And so what else we do within real estate is that the energy tax law came about in 2006, and it allows for substantial energy tax benefits when people design or redesign buildings that are energy efficient. And a licensed engineer is required as a third party to, confirm those energy efficiencies. So we do that as well. And hopefully through that tax benefit that we verify, we are able to produce, a lot of benefit in terms of cash preservation for our clients that are being conscious and, basically being energy efficient and making their buildings more energy conservative. So we help reward that and match the IRS with their buildings to qualify that as well. So that's kind of an overview on the real estate side in a summary level of, how we're helping our CPA firms help their clients or helping our family offices help their wealth preservation through these important tax studies. And on the R&D... Oh, go ahead.
Sorry, go ahead. Keep going.
I was just going to add, so on the R&D tax credit side, the research and development tax credit side, what we are doing there is being that independent engineering firm that confirms the labor and supply costs that our companies have devoted to improving manufacturing, producing a product, whether that's software, drugs, or some type of widget. And basically, that incentive, which now is permanent and now available for startups, is an important tax credit that refunds people in the United States that have the labor costs and supply costs spent here in the United States to produce these products and improve these products. And what's important about that is it's rewarding companies for keeping the employment cost here in the United States and obviously incentivizing them for that labor here in the United States. So it basically, at the end of the year, is a refund rewarding them for that employment and supply costs that they spend here in the United States, and we're that independent verifier of those, and we add those up so they can have those refunds at the end of the year. So all important tax benefits, all important to the family office community, and I find that these tax benefits are probably the most often overlooked tax benefits in the family office community. So when we are meeting with families, we find that 90% plus are not taking advantage of these eligible tax benefits, and I think probably because it's not only tax, it's engineering, so there tends to be limited resources and awareness about it.
Yeah. So with when you meet with a family office for the first time, and they've got some real estate assets, for example, what percentage of these tax benefits would you say are typically being used on a scale from 1 to 100? Is like 30% of these benefits, 50%, 10%? What do you typically see?
Yeah, it's probably under 10%. So there really is a low awareness. The families that are investing in real estate or investing in real estate funds or co-investing together are typically investing in real estate to look purely at the return. And unfortunately, a lot of that return can be greatly enhanced by being tax efficient and taking advantage of these rules that are applicable and very beneficial. But again, there's so low awareness that most families don't participate in these rules.
So in some assets that they own directly, it sounds like there's definitely a percentage increase in the type of returns that they could get. Do you have an idea of when these are utilized, how much that increases their return? I mean, it's usually 1 or 2 points, or it could be considerable depending on, the type of asset.
Yeah, I'll give you an example. So, we had a family recently invest in a new construction student housing property, and we went through that asset, and it was roughly $10 million, and we were able to qualify just over $3 million of immediate, tax write-offs from that project. So that $3 million of depreciation flow through to the families. And so not only were they getting a return, but they were getting $3 million worth of expenses to, one, offset the taxes associated with that return, and also use those additional expenses to offset other passive income that they had. So that $3 million at their 50% tax, bracket was, converting to about $1.5 million in cash benefits for that investment.
That's pretty significant too. I mean, that will definitely add to the bottom line and can make a big difference. So the common mistakes that you see, from what I hear you're saying, is people are just not aware of this, or family offices aren't necessarily aware of this. And why do you think that is, Julio? Do you think it's just because of awareness for the most part?
I think it's because of awareness. I think that typically when families are investing in real estate, they're purely investing for the return, and so they're looking at what this investment will do in terms of income. But they don't look at what it could do in terms of income preservation and, taxable income offsets through depreciation. And I think part of the low awareness is because many times the accounting expertise that they utilize doesn't have an in-house engineering department, and so a lot of times those resources are just missed. And so, that all comes back to awareness.
Wow. So what was I going to say? So now you've also touched on, I look at some of your material that you have, and you talk about the charitable contributions for real estate and how that can make quite a difference. Can you talk a little bit about that charitable contributions?
I think that's a great topic to bring up, and it's important in many ways. So basically, we'll have families that will go in and invest in multifamily student housing, and they'll basically do demolition because they're buying these properties for value add. They're going to go into a B-type product, redo the kitchens, redo the bathrooms, and try to bring the rents up. And it's always, been proven to be a pretty good strategy. But what happens? They take these assets, they basically demolish these cabinets, these appliances, these utilities that go within the kitchens and bathroom, and it goes to landfill. The better thing to do to be tax efficient is to basically take those same assets and donate them to a charity that, one, doesn't create more waste within a landfill, and two, allows for some charitable contributions, which again promote tax efficiency, charitable efficiencies, and overall wealth preservation, because although the buyers of this investment property, it may not be their treasure, it certainly is a treasure to the habitats of humanity and other charities out there that can use these cabinets, can use these toilets, can use these appliances, can use these flooring that would be definitely good for the people that they're building free homes for in their communities.
So they're taking out, through that rehab or that change within that building, they're taking what they're replacing, like you said, the toilets or whatnot, and then giving those away instead of throwing them into the trash bin.
Yeah, exactly. And, I would say that the same thing applies to energy, right? Most people are making their buildings energy efficient by putting in new lighting, new control systems, new HVAC systems, and they're doing it for all the right reasons, but they're doing two things that probably they could be doing better. One is they could, utilize the energy tax benefits that, have been promoted since 2006, which is rewarding them through tax incentives to be energy efficient. And two, they're taking out lighting and HVAC systems that, aren't beneficial to them per se. But to a charity, they could still be very beneficial. And so you could take advantage of energy tax benefits. You could donate the other assets to charity. And hopefully everyone
wins in that scenario. That's amazing, because to be honest, from my perspective, I've been involved in real estate for over 15 years, and I can't tell you how many trash bins I've seen or been a part of, and it's just gone to the waste area rather than being donated. And it makes me think about how many great items could actually have been given to charity, and could be given to charity all the time, and never is. That could add up to quite a considerable amount, not only in the existing projects that families might be involved with, but just in general. Nobody really markets that or talks about the reuse of a lot of these type of materials. It almost turns it into a social impact, event, in the fact that we're taking valuable products that can be donated to families and be very, impactful for their livelihood. But, we're also not sending these components to waste, and thus, overall creating a great social benefit as well as a very, nice benefit for the investors. So, I hope that more families see the importance of that. Oh, 100%. Julio, we're going to take a quick break, and then we're going to be back to talk a little bit more about, some of these tax strategies for family offices and their real estate. So we'll take a quick break, and we'll be right back. Okay, look forward to it.
Hi, this is Jim Freed, the host of Freed on Business on 880 AM The Biz in Miami, and you're listening to the U.S. Family Office realestate.com podcast. The podcast provides you real estate information designed specifically for family offices. Make sure you check out usfamilyofficerealestate.com for educational information for family offices, including white papers, fact sheets, videos, and podcasts. You'll also find information on specific markets and assets, real estate cycles, tax-efficient real estate investing ideas, and much, much more. That's usfamilyofficerealestate.com. Information for family offices by a family office.
So we're back to usfamilyofficerealestate.com. Today our guest is Julio Gonzalez, the patriarch of the Gonzalez Family Office, and also the president of Engineered Tax Services. Today we're talking about tax strategies for family offices in regards to their real estate. Julio, I have a question for you. I actually had the opportunity to chat with one of your associates at your firm, and the conversation came up about cost segregation and bifurcation. And I was wondering if you could touch on that a little bit. I understand, too, that you've recently wrote an article around that, actually, with ways that investment groups and family offices can maximize their values. So could you talk about that a little bit, please? Yeah, certainly. So, basically what, that issue revolves around is that when families co-invest with other families and sometimes institutional investors into a real estate project or fund, basically there's two situations going on there. One is that you have an institutional investor that doesn't pay taxes. So cost segregation, which we discussed, is the ability to take the building, break it into components so that we can accelerate the depreciation of the building significantly. Now, to an institutional investor that doesn't pay taxes and may be a majority investor in these projects, to them that's not beneficial because since they don't pay taxes, they don't need the write-offs. Okay, so, but for the family offices that can use all the write-offs possible, it's very beneficial to have a cost segregation study done. So, from their perspective, they're hesitant to invest into a fund or a project where there's institutional investors
knowing that they won't get the most tax efficiency. So how do we cure that? Well, there's sections in the code of the IRS tax code that allow us to cure this. And what that structure is basically the IRS will allow for the depreciation that can't be used by the institutions to be transferred or bifurcated to the families that can use it. Now, that's a quick overview, and there's some steps necessary to qualify that. So it's not just as easy as, taking the depreciation that the institution can't take and transferring it over to the families that can take it and have that benefit. But there's some rewards and risks for doing that. So typically the IRS is looking for, if the families are going to benefit, then there has to be some benefit to the institutions. And typically what that is to set up a bifurcation agreement within the partnership that basically says that we're going to transfer the benefits of depreciation from the parties that can't use it to the tax-paying partners that are able to use it, and in giving them back benefit for that transfer, perhaps what they'll do within that bifurcation agreement is take their capital out last, allowing the institutions to have their capital back first to trade the risk and rewards there. But there's other steps to it, and there's other details to that. That's where we get involved with our clients and helping educate them in those areas with their attorneys and CPAs. So it can be a great win-win. Unfortunately, funds are not typically aware of this. So, it's an education process, and we're getting there slowly, but we are starting to make some inroads there.
Great. So can a lot of families like to invest with other families into projects. So is this type of a structure something that could be done if the only investors were families, possibly, or does it really need to have an institution that's involved in that investment component?
No, that's a good question. It certainly can apply to just families that are co-investing without the institutional partner. And again, there, they'd have to come up with an agreement up front as to how that's going to be transferred to them and how they'll be offset by, taking some more risk on the capital side.
Got it. Well, Julio, it sounds like, your firm can provide a tremendous amount of benefits to family offices. And one thing I do want to note is that, although you're located down in West Palm Beach, you do have offices throughout the country from coast to coast, and it looks from north or south. What's the total number of offices that you have open right now?
Yeah, we have 16 offices nationally. And so we do work in every state. This is, a United States only tax benefit, so it just, remains to the United States. But we've done work in every state, and we've done work, as far as Hawaii, all the way down to South Florida, and everywhere in between. But because it's a federal tax benefit, so again, this applies to every investor in the United States that owns real estate. But it can also apply to foreign investors that invest in United States real estate as well.
Oh, so and it seems to me that for families that are investing into direct real estate or having multiple assets, that they could utilize the service over and over and over again. So once they meet with you the first time and find out that there's a lot of value add here, that would be something that they would want to continue to do.
Well, I think so. I think you always want to be tax efficient in your investments. And the nice thing, too, is that the IRS allows us to go back. And so what happens 50% of the time for our clients is that they're finding out about these tax strategies, and they've owned the building for a period of years already. But here's what the IRS allows us to do. The IRS allows us to do a study from an engineering standpoint, break out the components, and then we can reconcile, because a lot of times the families we're helping have already had a little bit of depreciation because they're doing the traditional slow method. So what we do is we come in and calculate the depreciation they could have taken under the engineering method. And then what the IRS allows us to do is catch up that difference. So let's do an example where we have a client, they've owned a building for 10 years, they've taken $100,000 of depreciation under the same building, different depreciation method for engineering, they could have taken $1 million. So the IRS allows us to catch up that $900,000 difference in the current tax return, and basically all we're doing with the IRS is changing the depreciation method from traditional to engineering, and we're doing a 3115, which is a form we file with the tax return saying we've changed our depreciation method, we're catching up all the missed depreciation we could have done under the engineering side, and going forward we're using that depreciation method. So, for people that own buildings and didn't take advantage of it in the past, not all's lost because they allow us to correct it.
Wow. And that's now, I guess only one question I'd have for that is that would only apply to buildings that are currently owned and haven't been sold. Is that safe to assume?
Yeah, I think that's when it's most applicable, is
right.
For people that have not sold their buildings, because once the building's sold, it would become much more complicated and probably not worthwhile pursuing.
Got it. Well, Julio, this is some great information. On our website, we've actually put up some of your flyers that goes over the high points of the services that you do offer. We also put up your the report and white paper that you wrote that can be pulled down for family offices that might be interested in more information. However, what's the best way to get in touch with you or someone at your company so that they could have further discussions on how you might be able to help them?
Well, that's wonderful. Certainly our main office line is 1-561-253-6640. Again, 561-253-6640 is our main line. And our website is engineeredtaxservices.com. That also has our 1-800 number. It also has online forms that you can fill in to get a benefit analysis. The nice thing is that when we do a project, we do the benefit analysis for free. We come up with what the tax benefits are going to be. So, there's no risk in doing that initial assessment and taking advantage of, looking at the opportunity, reviewing it with your accounting and tax team to see if it's going to be beneficial, and then moving forward. So, the risk in looking at it is, mitigated by the benefit analysis process.
Oh, fantastic, and I do want to say one other thing too, Julio. Our family office started becoming part of the family office community in the third quarter of last year, and so I've had the fortunate opportunity to spend some time with you, and the only thing that I've ever heard about yourself and your company is nothing but great things. And so very well respected. Anybody that's interested in getting more information, I would highly recommend doing so. And Julio's team and yourself, a great group of individuals, and it's obvious that some of the financial benefits that you guys can help with as well. So that's fantastic. Julio, I wanted to thank you very much for being on our podcast today. It was some great information. We're trying to provide more and more educational information for family offices all around real estate. And to me, this is a very important topic and an important area for family offices to be aware of and to explore.
Well, I appreciate you promoting the education, and our hope is that we can provide real value in terms of education to the families so that they can continue to maximize their wealth preservation strategies through these assets and investments that allow and really apply to these type of opportunities.
Great. Well, Thanks so much. Today it's at usfamilyofficerealestate.com. We've had the pleasure to talk with Julio Gonzalez with Engineer Tax Services and the Gonzalez Family Office. Julio, thanks once again. For more information, go to usfamilyofficerealestate.com. That's usfamilyofficerealestate.com. And we thank you for joining us today on this podcast, and we hope you join us next time for our next podcast as well.